when we say we want IVR over 30, there's a reason for that. And when you look at today's statistics, you look at IVR's tail on financial outcomes, you're going to see that there's such a big difference. Both this is the kind of the optimization of our mechanics. This is why IVR is so important. We needs to really be over 30, and you can't sell it too cheap. Let's take a look. So the team, because IVR has been low recently for the last month or two, it's recently going back up, but it's been pretty low. And we were really reaching for trades. We were finding some diagonals. We were doing this and that, but whatever. We were working our butts off to find some trades. And when IVR got back up over 30, all of a sudden it opened up a bunch more potential trades for us. So let's take a look why. In the realm of trading, the practice involves skillfully navigating trades with different implied volatility environments, a crucial metric in option trading that gauges market expectations for future price changes. When making trading decisions, it's crucial to consider both the potential for maximizing profits and return on capital, as well as identifying opportunities for risk mitigation. Wouldn't it be nice if we can mitigate risk and give ourselves the best opportunity at the same time? Therefore, this study aims to explore the influence of IVR environments on buying power, annual return on capital, and other historical performances, as well as risk. Okay. Let's go to the next slide. So the study is a full 18, 19 years, 45 days to expiration, 16 Delta strangles in the SPY, managed 21 days. And we look at historical performance and then buying power, return on capital. And we compared high and low implied volatilities, just to keep it simple. Next slide, Beth. Okay. So for starters, this table showcases how P&L, buying power, and annual return on capital behave when IVR is below 30 and when it's above 30. As IVR increases, also does the P&L and the annual return on capital, but the buying power, of course, is going to decrease because you're going to use less capital as you sell more credits. You're going to use less capital. But what's interesting here is, and again, this is a lot of combined. This is research taking 18 years worth of data, but the P&L is basically double. This is the most important thing because ultimately you're judged by your performance. Below 30, your P&L is 34. Above 30, your P&L is $69. That's how you get paid for taking risk. And obviously you want to be more aggressive and take more risk and high implied volatility. Your buying power is going to be lower. You're probably wondering, how's that? Why would your buying power be lower if you're making more money? And the answer is because you are collecting more premium, and the capital requirements don't change based on implied volatility like they do in futures. In equities, they don't change based on implied volatility. So you take in more credits, you have less buying power. And then your annual return on capital, of course, since you're using less capital and you make more money, your annual return on capital is going to be basically double. So the simplest discussion here is IVR over 30, good. IVR under 30, bad. And this is just a tiny little picture, a microcosm of what you would see in an equity marketplace. Let's go to the next slide. So that's cool. But with IVR below 30, the P&L and the annual return on capital decrease due to limited trading opportunities in low implied volatility. However, the buying power increases, requiring less capital for risk management. Actually, the buying power increases, requiring less capital for risk management. That's right.
He's saying you're going to use less buying power.
Yeah, you're going right. Got it. Right. So on the flip side, with IVR above 30, the P&L and annual return on capital tend to rise due to higher profit potential in volatile markets. However, the buying power often drops as more capital is needed to handle increased market uncertainty. Those are all fair. And those are all very straightforward. And those are all just products of all this crazy research that we do. Mm-hmm. Let's go next slide. So now we'll take a look at, when we also consider the risk and the win rate. So how do they behave in regard to IVR when it's above or below 30? And the interesting thing here is we found that CVAR, which is what happens in the worst 5%, the average of the worst 5% of all scenario. So like, give me all your bad scenarios, average them together, and give me all your bad scenarios down to the worst 5%. I mean, including the starting at 5%, going down to worse than that, and then average them all together. And what you'll see here, which is really interesting, is that the C-bar is actually less when implied volatility rank is actually higher. So,
which means, I mean, that's nothing.
We found that risk decreases as IVR increases, and the win rate pretty much stays the same. So the P&L is the same as on the last slide, 34 to 69. The C-bar actually goes down, but here's the other thing: the win rate stays the same. So you make twice as much money, you actually take less outlier risk, and you have the exact same win rate. The buying
sounds like I'll have what she's having, right? Yeah. I mean, that's what I would like.
But these are not things that are intuitive.
Yeah.
The buying power is lower, and the annual return on capital is double. The only thing we added to this slide are C-bar and win rate. This is what's so cool about what we do at Tasty, is that setting people up for a crazy, for trading success is not easy.
No, of course not.
If you don't take certain things into consideration, you just put yourself in such a difficult spot. Like if you don't realize that, hey, I'm not making any money because I'm trading all these really low IVR underlyings when the IVR is below 30. I'm not making any money because I'm not managing early. These are all managed early. I'm not making any money because I don't really understand. There's certain things you need to understand. You got to trust the numbers. Kind of got to trust the system. Yep. Let's go to the next slide. On the contrary, when implied volatility is high and the market expects significant price fluctuations, the inherent risk linked to the trade may be comparatively lower. This is because the trade has the potential to gain from more substantial and potentially rewarding price movements, also leading to an increase in annual return on capital. We usually don't talk about annual return on capital, but when everything stays the same, making twice as much money and using less money, it becomes more obvious when you look at annual return on capital. Mm-hmm. It's just a really interesting way to look at all the different stuff that we do. And let's go to the last slide. So in the takeaways, in the context of volatility, our study demonstrates that selling a trade under the 21-day DTE management window tends to yield more advantages in high IVR as opposed to low IVR. That should be a given. This suggests that in a high IVR environment, there's an 89% increase in the annual return on capital and nearly a twofold increase in P&L. It's correct. You saw the 34 to 69 and the return on capital, which basically doubled in the same, because it would be exactly double. However, the risk reduces relatively by 19%, and the required buying power is decreased by 13% in low IVR. So you're getting a situation where you're using less money, you have the same probability of profit, you making twice as much money, you have a higher return on capital, everything makes total sense. And it's all just based on a simple little thing like IVR. That's weird, but it works.
Sounds good, actually, right? Going back to some of the confirm and send questions we had from this morning.
Yeah, I mean, and those confirm and send questions, they're spot on.
Very good, very good. Let's take a quick 90-second break. Somebody else who's spot on, my friend and yours, Mr. Scott Sheridan, Tasty Trade World Headquarters, coming up next.